On the 1st of July, this year, something happened that almost nobody reported. The world's reinsurance companies, the firms that insure the insurance companies, cut their prices. Again. For the third time in 6 months. Property catastrophe rates fell by 20 to 25% for the best-performing accounts in North America. That is Gallagher Re's number, published 9 days ago. Guy Carpenter's global index is now down 16% across the year. That is the steepest annual decline since the 1990s. Now, hold that in one hand. In the other hand, hold this. The average American homeowner will pay roughly $3,057 for insurance this year. That premium sits 46% above where it stood in 2021, roughly 3 times the pace of inflation. 2 prices, moving in opposite directions, in the same month, in the same industry, responding to the same warming atmosphere. Somebody is absorbing that difference. Today, we go and find out who. This is the Veritas Brief. We are the podcast of Veritas Europea, a reader-funded publication covering European political economy, finance, and geopolitics. We take one story a week, and we stay with it. No hot takes, no panel, no 30-second explainer. We read the primary documents so that you do not have to. Everything we cite today comes from a named source, published between January and July of this year. Munich Re, Swiss Re, Aon, Gallagher Re, Howden Re, the European Insurance and Occupational Pensions Authority, the California Department of Insurance. We have linked every one of them in the episode notes and in the accompanying article, which is free. It is always free. Nobody pays to read us, and we take no money from the financial services industry. This episode is called The Slow Repricing. Let us start with what happened last year, because the industry's own accounting is where this story begins. Munich Re counted about $224 billion of global natural disaster losses in 2025. Insurers absorbed roughly $108 billion of that. Swiss Re, working from a slightly different methodology, arrived at $107 billion. The two firms count differently. They do not disagree. Both totals fell sharply against the previous year, when insured losses reached $147 billion. Now, if you were reading a press release from a trade body, this is where you would be told the industry is managing the risk. Losses down, balance sheet strong, nothing to see. That is not what the reinsurers said. Here is Thomas Blunk, a member of Munich Re's Board of Management, in the company's own annual release. Quote, read the quote plainly, no theater. Sheer luck spared the United States from hurricane landfalls in 2025. Sheer luck. Not modeling, not adaptation, not underwriting discipline. Luck. No hurricane made landfall on the American mainland for the first time in several years. That single absence explains most of the year-on-year decline. Swiss Re's head of catastrophe perils, Bals Grolemund, put it in almost the same terms. He described the shortfall as, quote, favorable variability rather than any easing of underlying risk. And Munich Re's chief climatologist, Tobias Grimm, described a year with, quote, 2 faces. The first 6 months of last year were the costliest loss period the insurance industry has ever recorded. The second 6 months were the quietest in a decade. Here is the number that matters most, and we would like you to hold on to it for the next 15 minutes. Swiss Re's own long-run trend line, the line the industry actually plans against, implied about $140 billion of insured losses last year. The industry booked $133 billion below trend. Not because the risk fell, because the weather rolled favorably. And global insured catastrophe losses have now exceeded $100 billion in each of the past 4 years. Howden Re makes that point in its June renewal analysis. That threshold used to signal a shock. It now describes a floor. So the reinsurers know the risk is rising. They said so, in writing, in January. And then, in January, April, June, and July, they cut their prices. Why? The answer is not complicated. It is just structural. And structural things do not make headlines. Reinsurers price 1 year at a time. That is the whole trick. They reset terms every January, and again in April, and again in June, and again in July. If a risk deteriorates, a reinsurer can walk away from it inside 12 months, which means capital, not climate, sets the near-term price. And there has never been more capital. Aon counts global reinsurer capital at a record $790 billion as of the 31st of March this year. Third-party capital, pension funds, hedge funds, sovereign wealth, reached $141 billion. Gallagher Re puts non-life insurance-linked securities capital at $135 billion, up 18% in a single year. Catastrophe bond issuance hit $15.6 billion by mid-June. That puts this year on track for another record. Meanwhile, demand for reinsurance at the mid-year renewals rose more than 10%. Demand grew, supply grew faster, prices fell. And the reinsurers are still, we should be very clear, extremely profitable. Gallagher Re estimates sector return on equity at close to 19% for last year. It forecasts 14 to 15% for this year. Aon recorded an average first-quarter return on equity of 14.1%. Both figures clear the cost of equity comfortably. Tom Wakefield, Gallagher Re's global chief executive, described the market in 3 words. Quote, strong capital, healthy returns, and increasing competition. Each of those feeds the next. Healthy returns attract capital. Capital sharpens competition. Competition compresses returns. This is the intellectual center of the episode. But somebody inside the industry has noticed the contradiction. Howden Re tracks something called economic value added. It sounds technical. It is not. It simply subtracts the cost of capital from the return you earn on it. It measures the cushion. That cushion is narrowed through every single renewal this year. David Flandreau, Howden Re's head of industry analysis, said this, quote, capital has rarely been more abundant in an environment of elevated risk exposure. Read that again in your head. Rarely more capital. Elevated risk. Falling prices. Jim Williamson, the chief executive of Everest Group, asked the sharper version of the same question at an S&P conference last month. He wondered aloud whether pricing discipline holds, or whether, quote, greed overcomes the fear factor. The 1st of January 2027 will answer him. A word about how this exists. Veritas Europaea takes no advertising. We take no money from banks, insurers, asset managers, or their trade bodies. We could not write this episode if we did. We are funded by readers and listeners. If you have not joined, the free email tier costs nothing and takes 10 seconds. If you can support us, membership is at veritaseuropaea.eu/membership. There is no paywall. There never will be. The work is free and it is expensive, and both of those things are true at once. Now we come to the part of this story that nobody reported, and it is the part that reaches your renewal notice. Here is how a reinsurance contract actually works. Bear with us for 90 seconds, because everything depends on it. A primary insurer, the company that sends you the bill, buys layers of protection above what is called a retention. The insurer eats the first tranche of losses itself. Above that, reinsurance responds. 2 numbers define the deal. The first is the rate on line, the premium expressed as a percentage of the limit. That is the price. The second is the attachment point, how much loss the primary insurer must swallow before reinsurance kicks in at all. That is the structure. In January of 2023, after a brutal run of losses, reinsurers hardened both. They raised prices, and they lifted attachment points, sharply. Now, this year, reinsurers have given back the price. They have not given back the structure. KBW, the investment bank, surveyed reinsurance executives in Bermuda before the mid-year renewals. Its analysts found pricing down closer to 20% than 15%. And they found the 2023 structural terms almost entirely intact. Reinsurers, KBW reported, are far more willing to accept a lower price than to reverse the structural changes they won. Sit with that for a moment. Higher attachment points mean the primary insurer absorbs more frequency before reinsurance responds. Frequency means hail, flash floods, wildfire, severe convective storms. And those are precisely the perils that are growing. Munich Re attributes $166 billion of last year's economic losses to what the industry calls non-peak perils. floods, wildfires, hail, thunderstorms. Insurers paid roughly $98 billion of that, a record for the category. Swiss Re reaches the same place from a different direction. Secondary perils generated 92% of global insured losses last year, an all-time high. American severe convective storms alone cost insurers around $42 billion and have exceeded that mark for 3 consecutive years. And the Los Angeles wildfires, Palisades and Eaton, produced roughly $53 billion of economic loss. Insurers covered about $40 billion of it, the largest insured wildfire loss on Swiss Re's records. So here's the sentence this whole episode exists to deliver. Reinsurers now sit above the hail, the flood, and the fire. Primary carriers sit inside them. And you sit inside the primary carriers. Insurance reaches you through a primary carrier, never through a reinsurer. And primary carriers file their rates with regulators, who approve those filings slowly and sometimes reject them, which produces a beautifully ugly asymmetry. Reinsurance increases reach households quickly because carriers file for relief immediately. Reinsurance savings reach households slowly, over years, if they arrive at all. Insurify projects a 4% average premium rise for American homeowners this year. That follows a 12% jump last year and a cumulative 46% climb since 2021. Deceleration is not reversal. And the national average hides the map entirely. Minnesota premiums rose 34% last year, Colorado 33%, Nebraska 25%, Oklahoma 24%. None of those states touches an ocean. The United States Treasury compared premiums across postal codes, ranked by expected climate loss. Households in the riskiest fifth paid 82% more than households in the safest fifth. Climate risk is already priced into household budgets. It simply arrives under a different name. Now, California, because California shows us the end game. The California Fair Plan insures homeowners whom private carriers have refused. Its policy count grew 44% between the autumn of 2024 and the end of last year, reaching 668,600 policies. That growth is not marketing. It is withdrawal. The January wildfires cost the plan roughly $4 billion. The plan then levied a $1 billion assessment on its member insurers, its first since the Northridge earthquake of 1994. And California regulators permit those member carriers to recoup half of their share from policyholders as a surcharge on ordinary renewal bills across the whole state. So a household in Sacramento helps pay for houses that burned in Altadena. They did not vote on it. Most of them will never know they paid it. Then, in May, the plan asked for a 35.8% statewide rate increase. The Department of Insurance approved 29.1%, effective the 15th of October. The wildfire component drives almost the entire increase. Some wildfire premiums will roughly double. Carmen Balber of Consumer Watchdog called the decision, quote, a real blow for consumers. And the plan now holds bonding authority under legislation signed last October, which means a state insurer of last resort can now issue debt to pay its claims. We are a European publication, so let us come home. Europe recorded only about $11 billion of natural disaster losses last year. Insurers covered roughly half of it. The 10-year average is $35 billion, so last year flattered this continent badly. And that calm disguises something structural. EIOPA, the European Insurance and Occupational Pensions Authority, reports that insurance covered only around a quarter of European extreme event losses between 1980 and 2024. A quarter, across 4 decades. Its Eurobarometer survey found that just 17% of respondents hold natural catastrophe cover for property damage. 17. Petra Hilkema, EIOPA's chairperson, rejected the entire historical method in a speech this April. Quote, "We are operating in a new risk paradigm. The German Insurance Association has warned that property premiums could double within a decade. EIOPA cites that warning in its own supervisory commentary. So Brussels is reaching for a pool. In April, EIOPA and the European Stability Mechanism proposed a Europe-wide risk-sharing framework, a catastrophe pool paired with a loan-based public backstop for extreme tail events. It would sit beside national schemes rather than replace them. Italy moved first and moved harder. Rome now requires almost every registered business to carry catastrophe cover. Micro and small enterprises faced a 1st of January deadline this year. The state agency, SACE, absorbs up to half of the insurer's indemnities. Notice what each of these mechanisms does. California issues bonds. Italy deploys SACE. Brussels proposes a pool. Every one of them performs the same conversion. A risk that private capital declines to price migrates onto a sovereign ledger. None of them reduces the hazard by 1 degree. They redistribute its cost across time and across taxpayers. That buys adaptation time. It also mutes the price signal that would have driven adaptation in the first place. Which brings us, finally, to the argument that got a German insurance executive briefly famous. Günther Thallinger sits on the board of management at Allianz. In March of last year, he published something remarkable. Not a press release, but an argument about the limits of insurability itself. He wrote this, quote, "It is the last quote of the episode. The math breaks down. The premiums required exceed what people or companies can pay." Thallinger argued that entire regions are already losing access to cover. Then, he followed the chain outward. Nobody mortgages an uninsurable house. Nobody finances an unmortgageable one. He called the result a climate-induced credit crunch. And the transmission mechanism is not theoretical. In Louisiana, high insurance costs sink 30 to 40% of mortgage applications. A survey this year found 21% of American home transactions collapsed over insurance problems. Ishita Sen, who studies insurance markets at Harvard Business School, warns that, quote, "Some households may end up defaulting on their mortgages when insurance costs rise." First Street estimates that insurance underprices climate risk on 39 million American properties, 27% of the housing stock. It projects roughly $1.5 trillion of housing asset losses over the next 3 decades. That is not a projection of fire damage. It is a projection of repricing, of buyers finally subtracting the cost of cover from what they are willing to bid. There is a way out, and the numbers on it are unusually good. Swiss Re calculates a median benefit-cost ratio of 1.86 across adaptation projects. Every dollar spent returns almost 2. Allianz estimates that catastrophe losses typically cost about 10 times the price of adaptation. And it shows up in the data already. Swiss Re credits dikes, levees, and land use rules with constraining insured flood loss growth in Britain, France, Switzerland, and Austria. Adaptation lowers vulnerability. Lower vulnerability preserves insurability. Insurability preserves credit. The chain runs in both directions. That is the good news, and it is the only good news we have for you today. So, let us say plainly what we have found. Climate change does not bankrupt insurers. It reprices them, and it reprices everybody standing behind them. Reinsurers reprice annually and shed risk within a year. Primary carriers reprice slowly and answer to regulators. Households never reprice at all. They pay, or they cut their cover, or they leave. More than half of American homeowners, surveyed by Insurify, say they have made financial sacrifices to afford coverage. Nearly 3 in 10 say they would drop coverage entirely if their lender allowed it. That number is the real protection gap, and no pool in Brussels closes it. The industry has already run the arithmetic. It is concluded that the risk remains priceable, for now, at a price. The question we cannot answer, and nobody in Bermuda will answer for you, is who can still afford that price in 2035? The full article, with every source linked and 4 charts, is at veritaseuropea.eu. It is free. We are Veritas Europea. Thank you for listening. We will be back next week.